Hello, my name's David Cheetham, Chief Market Analyst at XTB, and today I just want to talk about a short video where I'll be explaining some of the changes that will be coming from ESMA regulations and how that could impact on your trading. So I think there's three key changes that ESMA, which is the European Securities and Markets Authority, have announced, and these will apply to all CFD and spread bet trading for EU-based brokers. The biggest change arguably is the restriction in leverage available to retail clients, which will be now cut to between 30 to 1 and 2 to 1 depending on the asset class that you are trading. A second also important change is that margin closeout will now occur at 50% of your margin requirement, which is higher than the 30% previously. So essentially this means you will get margin called and closed out of losing trades more quickly. There's also prohibitions on firms offering monetary and non-monetary benefits to retail traders, such as cash-based incentives, so there will be no more of this offered to retail clients. There are other measures, such as negative balance protection, but we already provide this at XTB, so you won't see any dramatic changes concerning those so much. So how will this impact your trading? So starting off with the major currency pairs, so talking about Euro US dollar, Pound US dollar for instance, the new leverage restriction on these will be 30 to 1, down from the current levels of 200 to 1. I'll go into a little bit more detail how this breaks down with an example in a moment. If you're trading non-major currency pairs, Pound Aussie, Euro CAD, that will be 20 to 1, which will also apply to gold and major indices, so US 500, D30 for instance. All other commodities will be 10 to 1, and non-major equity indices, so we don't offer many of these. The majority of the indices offered on XStation fall under the major bracket, but some of these non-major indices, such as the Hong Kong Composite or the COSP 200, will have 10 to 1 leverage restrictions. Examples of commodities which will have this leverage restriction now will be oil and wheat, for instance. Individual equities, so your Amazons, your Facebooks, Netflix, Alphabet, Google parent company, they'll be restricted to 5 to 1, and cryptocurrencies have the most stringent leverage caps, where they'll be capped at 2 to 1. So here's a table just to show how some of these leverage changes will be calculated and what it'll mean for you if you're trading. So for this example, I've chosen Euro US dollar. You can see on the left hand side here, if you're trading at present Euro US dollar, if you're trading one lot or one contract with a leverage of 200 to 1, then you have a margin requirement of £445 to open that trade. The pip value per pip would be £7.62, so that's important for what I'll come on to in a moment. After these ESMA leverage restrictions come into play, the leverage will be capped at 30 to 1, so that would mean to trade one lot or one contract in Euro US dollar, you'd need more than 6 times the margin requirements. You'd need £2,967, but notice the pip value is the same. The exposure to the market is exactly the same, the only difference is the leverage. However, what this means is if you only utilise the same margin in your account, so going back to the first example, if you only utilise £445 margin, you'll only gain exposure of 0.15 lots in the market with the leverage of 30 to 1. What this would result in is a pip value of only £1.14 per pip. So what this means is you actually have far less exposure to the market. Now, ESMA have put these restrictions in place to try and protect retail clients who they believe aren't fully aware of the exposure they're gaining in the market. So I think this could have obviously implications for how you look to trade. Now, if you are unsure about margin or anything like that, I'd always recommend getting up a trade calculator. This is just a screenshot I took earlier of Euro US dollar from our XStation platform. And what you can see is a breakdown exactly of what the trade entails. So you can see the volume there of 1 has a contract value of 100,000, requires a margin of £445. Just below that, pip value £7.62. Now you can change any of those three, the volume, the contract value or the margin, and you'll see the others change in kind, and that will show you your exposure. So for instance, if you were to halve the volume, contract value would halve, margin would halve, pip value would halve. If you double the volume, etc., you get the idea. Okay, so any positions that are opened up until the 28th of July will not have these new leverage restrictions applied to them, and as a reminder, all our CFD contracts, barring the cryptocurrencies, can be kept open for up to 365 days. So these regulatory changes won't impact open positions, they'll purely be applied to new positions opened after the 28th of July. Now, there's two real impacts I think this could have on the way that clients choose to trade. Firstly, I think some clients may look to increase their account size. They may look to deposit more funds to get the same levels of exposure as what they're used to previously. So just going back to this Euro-US dollar example, like I say, if you are trading regularly one lot of Euro-US dollar with £445 margin, if you want to carry on trading one lot of Euro-US dollar post these ESMA leverage restrictions, then you'll obviously need far more margin in your account to have the same exposure. There's also the consideration of the new margin closeout. Now, because your margin closeout will be closer to your opening balance when you enter trades, some clients may wish to top up their account so they have greater funds available in the account, so they're not subject to being closed out so quickly if the market moves against them. So there's less room for volatility essentially versus the 30% margin closeout which was previously in place. I think it could also lead to a change in trading style. Some clients may look for shorter term time frames to trade more actively in and out to get in the market more quickly, or alternatively they may look to hold positions for longer. Again, going back to this, if you look at Euro-US dollar, if your pip value is so much smaller, you may look at it from the point of view that you're looking for more pips per trade to try and make the same profit. So these regulations I've been talking apply only to retail clients. If a client qualifies as a professional, then they are exempt from these new regulations. If you're interested to see if you could become a professional client of ours, get in touch with your account manager and they can help you through the process. If you are elected as a professional, you'll get to keep the negative balance protection. You'll also still have segregation of funds and the FSCS protection up to £50,000. You also have the right to request a different categorisation, i.e. you can request to be moved back to a retail client, and you also keep the financial ombudsman service. However, you do lose the new leverage restrictions. So for instance, if you trade Euro-US dollar, you would still have the old leverage restrictions of 200 to 1 rather than new ones of 30 to 1. The risk warnings won't be as stringent because essentially we'll be assuming you are professional clients who have more detailed knowledge of the product, and also that will also apply to communications and financial productions. If you want any more information, please visit the website along the bottom there, and I'll just show you this landing page. So if you go onto our website, Traded Services, and then over to Elected Professionals, you'll come up with this. You can see here, become a professional client, retain up to 200 to 1 leverage. You need to match 2 of the 3 criteria to be considered as an elected professional. If you are interested in that, you can fill in this form on the right hand side or get in touch with your account manager.